Hi everybody, Natasha Koch here with the Van City Home Team and our usual Van City Scoop Live. So today, it's a little bit of a dry topic, but it's actually a really important one. So we're going to, hi Jeanette and Chelsea. We're going to talk about 9 ways to outperform a slow property market. So really, there's slow property markets all over the world. It's not just in my particular city, but we are definitely finding that there's a little bit of an economic crunch right now. But that's not necessarily a bad thing. So, well, let's talk about that. So, a rising tide lifts all ships. Here's a quote that I'm reading. And one of the worst things that can happen to a beginner investor is to have everything go right. And I know that sounds funny. Hi, Lizelle. Hi, Connie. I know it sounds funny, but the truth is that when you first invest in real estate, if you make, $100,000 on your first investment, you're going to think that that is the way that it actually happens. And the truth is that that's just a lucky investment, and it's not typically the way that investments go. So let's talk a little further about the 9 ways to outperform a slow real estate market. So number 1. You want to outperform the averages. So you're buying a property, you're not buying, hi Lisa, you're not buying the market, you're just buying one independent property. So you want to, what I call an investment grade, you want that type of property. I'm going to talk about, buying ones that are an investment grade and how that is. Basically, owner-occupied properties. Hi Henry, hi Naomi, thanks for joining. Basically, those are properties that are owner-occupied areas that people will drive up the prices based on emotional investments. And so you want to focus in on those properties because those are the ones that are going to make you the most money. Hey, George. Number 2, you don't want to try to outsmart the market. A lot of people think, there's this great new area. It's really super cheap to buy a property in. Let's focus. I heard it's going to boom. Sure, maybe it might boom. And to be honest with you, I'm a bit guilty of that because I have, hola, Naomi. I have actually bought in areas that I really knew nothing about, and I just happened to get lucky. So you don't want to try to outsmart the market. Pick an area where you know is a good solid area, and I'm going to give you some tips on how to do that. Usually those markets actually are the more affordable areas because they have a little bit lower income, and so they're usually the ones that suffer the most if there is an economic crunch, for sure. Hi Yvonne, thanks for joining. So where you want to focus on is number 3, and that's the inner and middle ring wins the race. So let's talk about what I mean by the inner middle ring. This is the area where people can financially afford to live there. This is the area where, and it's usually closer to the city center, where it's a little bit more expensive, but that's where people's jobs are, and they're in a little bit of a higher income bracket, so they don't mind upgrading to a more premier property. And it's usually areas, that are that have many lifestyle attributes, usually downtown city centers. Number 4, free advice. Free advice isn't really free, even though I'm giving you some right now, but it's not advice, it's just some information. So everybody likes free stuff, but be careful where you get your free advice from. So when a market's flat, it's the time that you want to actually look at people who have made some really solid investments, and those are the people that you want to get advice from. You don't want to get advice from people that just happen to make money on a whim because they were first-time lucky investors. Talk to people that have had some solid investments that were not affected by any kind of fluctuation in the market. Because number 5, horizon matters. So as we know, if you look down when you're on a boat, you may start to get seasick. And it's because you're looking directly down, you're not looking at the horizon. And when you look at the horizon, everything sort of levels out. So it takes a long time for an investment. People think that just because real estate fluctuates, that you can sort of jump in and jump out. But really, as far as an investment strategy, you should be looking at it as a long-term strategy. Any investment, really, you should be looking at least 10 years to sort of determine whether or not it's going to be a good investment. So you have to ignore those short-term market fluctuations. And so just keep your eyes on the horizon. When things fluctuate and the market dips a little bit, if you have made a really strategic plan for your investment, it shouldn't affect you at all. So let's talk about how to select an investment grade property. Hi, Jamie. Thanks for joining. So number one, you want to buy at the right stage of the property cycle. So look at the big picture. Look how the economy is performing and where you are actually in that property cycle. You want to look for the right state in which to invest, one that's going to deliver future economic growth, and that is going to lead to job growth, population growth. So that is the right state of the market to be buying in. Number three, you want to then narrow it down to the right, you want to look in capital cities. Bigger areas are usually where they're going to experience the most economic growth. So you want to look at, Toronto and Vancouver and some of the major cities. Then once you've chosen your city of where you want to invest, then you want to look for the right suburb within that city. And so you want to kind of look at a history in that suburb that has outperformed the averages. So you kind of want to look over a 10-year period and see where they've outperformed. Number four, then you want to look for the right location. So now we're kind of getting to the right location within that suburb. So, most people make the mistake of going right for the house, but the house is actually the last thing that you should really be looking at. You need to look at all of these other factors. So now you're looking at the right property. So now you're looking at the right property. You found the areas, you found the suburb, you found the city, and now you can go into the last aspect, which is the right price. You don't want to look for something cheap. There's always cheap properties in this world. You can find them anywhere. You want to look for something that is going to be worth it in the long-term investment. So let me tell you a few strategies on what would make a property worth it in the long-term investment. Number one, it appeals to owners. So I mentioned this earlier, owner-occupied areas, they retain their value. It pushes up the price of real estate automatically because it's owner-occupied predominantly. Number two, you want to focus on below intrinsic value. That's why you want to avoid, and I know that people don't want to do this, but new builds, they come at a premium price because they're usually off a plan and they're at the highest possible price. You can find the odd one where you'll get lucky, but generally you want to look at something that's below intrinsic value. Number three, with a high land to asset ratio. So that doesn't necessarily mean a large block of land, but it means that the component is a significant part. So take a look at the tax assessments, take a look at how much the value is allotted to the land, because obviously you've heard the saying, they're not making anymore. Focus on the land. And then you want to take a look in the areas that have a long history of strong capital growth and that are continuing to outperform the averages. So those are the areas that you want to focus on. And then with a little bit of a twist, you want to find a property that has something special, different, or scarce, because obviously scarcity will stand out in the crowd, basically. Hi, Bryn. Hi, Lise. And hi, Amanda. Thanks for joining. And hi, Marshall. Okay, and so where can you manufacture capital growth? Through refurbishment, renovations. So capital growth, if you want to upgrade the property, you can make some money in a certain area based on those improvements as well. So number 7, location not negotiable. So I think I mentioned earlier, location, location, location. And it's absolutely true because 80% of your property's performance is determined on location. So it's really tempting sometimes to think that there's a brand new area and it's going to be a brand new, fantastic, up and coming location. But why would you want to look at something that might work instead of looking at things that have always worked. So look in the areas that have always worked. Number 8, know your finances. I've talked about this before, and I have a new friend actually in the financial industry that I'm going to introduce. We're going to do a live together, and she helps people with their finances. I will introduce her at a later date, but for now, just know your finances. Make smart decisions and make sure that you've got some room or a buffer, a line of credit for those times where you might not have rental income or you need to do some maintenance on the property. So super important that you have enough money. Number 9, which is basically the last one, which is never set it and forget it. We're kind of in this state where we think that we can just set everything and forget it and it will all be automated. But the truth is that if you really want to have an investment, you need to manage your investments. I don't know any investors that don't constantly modify or manage their investment and get rid of what's not working. I mean, you have to assess it in order to do that. Hi, Corrine. Hi, Lori. Wow, you guys are awesome. Thanks for all joining today. So, I mean, there's no point in hanging on to a property that's not serving you well and not making you, well, not initial money, because we're looking at the long term, but you want to, make sure that it's not going to drag you down for your financial future. So the bottom line basically is now you've realized that successful property investment doesn't really have much to do with the market at all. If you follow a proven strategy and point out, only go after a property with high investment grade in the middle ring city suburb that outperforms all the averages, you can't really lose. I mean, and that way you're not relying on the upswing of a market. And if you keep your eye on the horizon, you're always going to come out on top. Okay, I hope you guys enjoyed that. I hope it wasn't too heavy of a conversation and topic. And I look forward to seeing, oh, thank you. Thanks, Bryn. And thanks for joining. And we will see you all on Thursday for the Van City Scoop. Bye, guys.